If I told you I was going to buy your business for $1 billion, I'll give you $1 million today, and the other $999 million if you could swim across the English Channel with 100-pound weights strapped to your legs. Is that $1 billion offer? Today's video, we want to talk about the structure of deals. And so the key variables of selling a company, we usually say there's the value, there's the structure of the deal, there's a transition period for ownership, and then there's what happens to the key stakeholders, community employees, etc. But in today's video, we want to dig into structure. What we mean by that is that if you're on one end of the spectrum, you got all of the money for the sale of the business the day of the closing, and on the other end of the spectrum, you got all of it 10 years in the future. When you hit that 10-year mark, or for any other reason, we're going to talk about what is in between, because in a lot of situations, particularly in the middle market and lower middle market, there's structure involved. And so when you hear that phrase, well, this offer is going to have some structure to it, it typically means that there's going to be some consideration at closing and some over time. Obviously, as a representative of our clients, we want to maximize the amount at closing, because that is truly the riskless capital, and then mitigate or minimize the risk respective to the rest of it. And these comes in different shapes, forms, and fashions. And so in today's video, we'll start with the worst and move our way to the best, or least bad, however we want to look at it, structure that we see in these types of transactions. So we find the worst type of structure is when someone says you'll get X at closing and you'll get Y over time based on the earnings of the business. Now, A, if you sell the business and you're not involved anymore, you have no control over the earnings of the business. And B, the cost structure by which you run the business may be very different to how the cost structure is on a post-transaction basis, particularly if your business is going to be sold into a larger aggregation of businesses, or may just be a business unit. Oftentimes, if you become a business unit of a larger organization, you could have overhead costs kind of allocated to your business unit that could make your profit smaller or larger. And look, have we seen situations where it's manipulated in a way to minimize earnings? Sure, but more often than not, it's not a malicious thing. It just creates a lot of complication, and it's a very difficult thing to gauge because it's not going to look the same post-transaction as it did pre-transaction. So we really want to avoid EBITDA or earnings-based earnouts as any structural components of a deal. Next, which is a little less bad, are revenue, right? And so you think sales of a business. Now, it still suffers from the same problem that A, you're not in control post-transaction, but B, it's a little more quantifiable because you can say, okay, well, how many widgets did we sell? How much service did we sell? But again, it can be complicated because if you are then consumed by a business, say you're a distribution company that sells industrial components into the aerospace and defense industry, well, if you are bought by a larger organization that does the same thing, and some of their business units sell similar products, well, when the phone rings, which way does that sale get pushed, right? And again, not always a malicious thing, but sometimes just complication can make the post-transaction revenues of a business look very different than the pre-transaction. So it either has to be incredibly well defined or ideally avoided. So moving down the food chain, another creative structure we've seen is what are called conversions. And so if a business is being sold because certain customers can be converted from the old type of customer to the new type of customer in which they are worth more to the acquirer, well, they're going to say, well, if these things don't convert, if these clients don't convert, then it's not going to be worth as much. So we have to kind of hold back or structure the deal in such a way that some of the non-closing consideration is predicated on these conversions taking place. And the challenge with that, again, is you don't have control over the company, but even more specifically, you don't have control over the customer relationships. And so if some heavy-handed salesman ruins these relationships or is overly aggressive or doesn't do things with the same level of finesse or intellect as the selling company, then these people may not convert. And so again, it comes down to that same variable and that same consideration. And the only time we've really been comfortable with these types of things, so they have been parts of certain deals where it is a meaningful value catalyst, and the reason why the acquirer is paying so much money for something is that there has to be an incredibly well written out cadence and pacing to not only when, but how these conversions will take place, so that the same type of approach that prior ownership took to these conversions can be utilized by future ownership as well, again maximizing the odds that it takes place, mitigating the risk, and giving the seller some level of control because they've created the blueprint that is to be followed by the new acquirer. Next is going to be client retention. And so that's going to be, doesn't matter how much the clients spend or the revenue, but it's going to be that the clients are retained, that clients aren't lost. And usually when this is a part of a deal, we want to minimize. It's not just all clients, but maybe there's a few key clients. And if there's a high level of confidence from a seller that these few key clients are going to stick around, then okay, then some part of the deal can be predicated on the retention of them post-closing. Again, we want to keep that timeline short because yesterday's favors are forgotten quickly. And so if new management and ownership doesn't do things in an ideal fashion, then can it tarnish things and lose these customers? Yes. So again, we want to keep it short. And oftentimes, if again, going to another variable of deals, the transition of the seller is going to stick with the business for some period of time. If we can correlate the retention to that same period of time, well, even better, because then you again have that level of control back. So now after client retention, we want to look towards employment. And so again, it brings into consideration the transition period for a selling owner or management of a company. But if there's some consideration at closing, and the balance of consideration post-transaction or post-closing is going to be predicated on the ongoing employment of an individual for a certain period of time, well, we like that because A, there's a level of control, and B, it's for a finite period of time that's negotiated. Now, what's important of this is that we don't want to put ourselves in a situation where new ownership can kind of torture a seller into a position of leaving early and leaving some dollars on the table. The person's role post-transaction, to the extent they're involved, needs to, from our perspective, be A, tapering, and so perhaps the same for some 90 days or some period of time that's very short, and then tapering off from there, and then B, in a well-defined manner, both relative to time as well as roles and what they're going to be doing, what the expectations are. And so that they're not just trading the ownership of a business for a job where they're doing exactly the same things. Oftentimes, if someone sells a business that they've been owning and operating, but their favorite part was sales, well, then maybe they focus their time for the time that they're involved on retention or enhancement of clients. And on the other side, if they're more of an operations person, then maybe they stick to the back office part of things, post-transactions for the time that they're involved. But employment's a more well-defined structural component of business. And lastly, in the structural component that we like best, to the extent that we cannot get 100% of the consideration at closing, is simply the passing of time. As they say, Father Time has been and remains undefeated, and we can let that work to our advantage in certain situations where $1 is going to be at closing and another $1 is going to be over 2 years, but for no other reason than the passing of time, then your only real risk there is effectively the credit quality of the acquirer, or the confidence that the acquirer is not going to go out of business in that intervening time period. And there's ways to structure it even more so from a seller's perspective to get some assurance there, either from a sense of collateral or foreclosure rights. There's a lot of different ways to do it where it effectively works like a seller note or debt basically being held by the seller, but that gets into some more granularity. But the point being is passing of time. If you have to wait post-closing for any part of the consideration for a deal, the more you can make it just based on the passing of time, the better. And so let's summarize this. From worst to best, the structural components of a deal, or the mechanisms by which you may receive consideration post-closing for the sale of a business, are, again, from the worst side to the best side, EBITDA earnings, revenues, conversions, client retention, employment, or the passing of time. And to summarize all of this from a conceptual standpoint, the variable, the motif that we've kind of emphasized here that plays through all of these things and that changes or differentiates whether something's good or bad is the element of control. The more we can control it, the more we have certainty, the more we mitigate risk, the better it is for our clients. And that's what we focus on when negotiating these. I hope the week continues to go well for everyone. God bless. Keep pushing forward. We'll see everyone next time.